And thank you for joining the Clean Energy Collective webinar. My name is Mike Steiner. I am our key accounts specialist at Holy Cross Energy, and I will go through some of the options and overview of the CEC project that everyone has subscribed to. In spring of 2020, Holy Cross Energy was informed that the Clean Energy Collective was exiting the community solar business. This impacted projects located in Holy Cross Energy's service territory. There are 4 projects located in Carbondale and in Rifle that our members have subscribed to. Other electric utilities are also impacted from CEC's decision to exit the community solar business, including other Colorado utilities, Minnesota utilities, and Kansas utilities. HCE was given an option to purchase arrays located in Holy Cross Energy's service territory from CEC. And as many of you know, Holy Cross Energy is a not-for-profit, member-owned entity. So we share costs with all of our membership. The goal of Holy Cross's acquisition in the CEC solar arrays was to provide an equitable value for its members. Holy Cross Energy felt that if it did not intervene, it could result in increased costs to all. So Holy Cross Energy staff and board developed 3 options for its subscribers. And we'd ask members to evaluate each option, which was mailed to you. And if you could fill out which option you'd like to select, please mail that back to us with the envelope and the posted marked envelope no later than January 1st, 2021. I'm going to go through option 1, which we feel provides the best value, and that is Holy Cross Energy will purchase your panels. Holy Cross offers a purchase based on the net present value of energy production from your panels. We included several factors in valuing the purchase price offered to you. The first is your panel capacity. How many panels do you own? And we base this off the payment rate that you received for the original term of the program. We have members enrolled in various years, 2011, 2015, and 2016. So there are different terms of the program, and some of our members have enrolled in the program in various years. We also projected additional post-program energy payments, and that is the shorter period of time after the program ends and the earlier of the remaining life of your panels and the term of your customer agreement with the CEC. I'm going to continue on option 1. The calculation uses the energy payment terms through the original end date of the program. After the program, Holy Cross Energy estimated avoided cost payments that go into this calculation. Our avoided cost is where we can purchase power off the current market from our wholesale suppliers. So that's how we calculate our avoided cost payment. We also added the value of our Pure program, which allows members to offset 100% of their energy usage with a renewable energy resource. And so we base this calculation off our members' 2019 usage, and we added this value in through year 2030. So you'd be receiving an additional funds based on our Pure program. You don't have to enroll into Pure. We'd ask you to consider it. If you don't enroll, you can take that cash. We think option 1 eliminates several risks. It's a reduced energy production that you might receive from weather damage or degradation to the panels. Also, option 1 eliminates future property tax payments and IRS 1099 income reporting obligations. We also came up with option 2, which would be sign a new agreement with Holy Cross Energy. This would be similar to your old agreement where you would receive monthly bill credits on your Holy Cross bill. The old CEC pricing calculations are no longer available if you choose this option. HCE would be compensating members similar to the old agreement, production of the panels times a new energy price. And we base this off our avoided cost of power, where we can purchase power from one of our, instead of purchasing from an asset, we can purchase power from one of our wholesale providers. The old program rate is approximately 12.7 cents per kilowatt hour. So the new agreement rate would be approximately 3.5 cents per kilowatt hour. And we change that annually based on our avoided costs of energy. So you can see you'd be receiving a much less bill credit. Also, option 2 is subject to property tax, and HCE will file an IRS form 1099. You'd also have the risk of panel damage, degradation, and the variability of solar production from the panels. The third option is if you'd like to terminate this agreement. And I want to note that the previous CEC program that you're enrolled with will not be supported after 90 days. You can provide Holy Cross Energy with a termination notice. And this was available in your original agreement with CEC. And we can provide you with your panels from the site, or we can provide you with alternative panels. And there'd be no financial credits that you're seeing currently provided from Holy Cross Energy. And I'd like to open it up via chat if anybody has questions.
Mike, this is there was one question in the box from Randy Robeson. What discount rate did we use to determine the net present value? And we used 8.25% discount rate in the calculations.
Okay, Steve, Lisa, do you guys see any other questions coming through the chat?
Yeah, actually, I do see more. And hang on, I'm just scrolling through it. The box for me is so small, I can't see all the questions at one time, unfortunately. Steve,
we did have one question that came across and asking about the Rifle Airport Array. And so currently there are 3 of the 4 arrays involved in your member buyout information. The Rifle Airport has 2 arrays. One, known as GCASA, came online in 2015 and is included. The fourth array is not included in the calculations. Due to tax benefits, that one was not offered to us for purchase at this time. We do expect that Holy Cross Energy will take possession of that array in late spring of 2021, at which time anyone participating in that array would be offered similar terms.
Thanks, Lisa.
I see a question from Randy Robeson. This is Steve Boyning. The question reads, as I recall, there's a receivable due to the owners from CEC. It was created to ensure the credit worked. What happens to those notes? I'm not familiar with what that detail is. And I wonder if, Mr. Robeson, if you have a note, if you could forward that to us. And so we can evaluate that and give you a more detailed answer specifically. I see there's another question from Rebecca Driscoll. The question reads, I had a 50-year program that began in 2013. The contract appeared to guarantee and ensure the term and contract. What happened to that guarantee? I was told it would, oops, my box keeps moving. Sorry, I lost the question again now. Continuing with her question, sorry, this thing keeps moving on me. I was told honored if they went belly up. So I do want to talk about one of the details on this. The program with a capital P is defined in the agreements and lasted in these 3 arrays for a 20-year period. Your contract with CEC is not of the same duration in some cases as the program itself, but the pricing terms are only applicable for the period of the program when CEC owned the arrays. CEC had a contract with Holy Cross that set the terms of the program. And in option 1, even though the program terminated when CEC sold the arrays and the contract between CEC and Holy Cross no longer existed, under option 1, we will provide the panel owners recognition of the payments they would have received discounted on a net present value calculation based on the pricing that was established in the program. So that's our recognition of the equity issue around the program, even though contractually Holy Cross has no obligation to continue to honor those terms. The program, as that term is defined, expired when CEC sold their assets. But we are offering to you the option to accept that value in a single lump sum cash payment as we've estimated it to be.
Steve, we had another question from Mike Yang. Can you please explain how the weighted average cost of capital is calculated and assumptions used to derive the 4.6? And it's moving on me again.
Yeah, that's very distracting, isn't it?
Yeah. And Mike also asked, can you please explain the risk adjustment of 4%? How was that derived?
Yeah, and Michael Yang, I assume the 4.16 is a typo. Our corporate weighted average cost of capital runs 5.25%. The further risk adjustment on the 4%, I'm sorry, the 3% additional risk adjustment. Your question says 4%, but the 3% additional risk adjustment was related to the variability of production from the panels, the degradation of the panels at 0.5% per year, and the property tax risk assumptions. These panels, it's our understanding, previously were property tax exempt, but that property tax for the panels and for the site, it's our understanding, becomes applicable to the project starting in 2021. So those were some of the factors involved in our calculations.
And Jay Harrington had a question. It seems that you're both discounting maintenance on future risk and keeping the escrow's maintenance fund. Is that correct?
That's correct. So there's a couple of elements in answering that question. I should say, under the old terms of the program, 10% of your panel's production was paid for by Holy Cross, and Clean Energy Collective put those dollars into an escrow fund that they used for operating and maintenance payments for the site and inverters and common equipment. Now that Holy Cross owns the site and inverters and common equipment, we margined or calculated the net present value of the buyout, assuming that sale continued to provide its share of contribution to O&M expenses. But we won't have an escrow fund. We'll pay that we'll pay the operation and maintenance cost for the sites out of our corporate expenses. And the 10%, if you do stay as a panel owner, if you choose option 2, we will continue to escrow 10% of your production for purposes of covering O&M associated with your share of the facility's costs.
And Mike Yang had a question. Are governmental agencies that are tax exempt still subject to property tax?
I don't know. I'm sorry, I'm not a tax expert and don't hold myself out to be one. And that would be a question for you to evaluate with your tax advisor.
Okay. And here's another question from folks calling in, as well as when did the solar credits end on monthly invoices?
So we expect that we've offered to the members as part of this communication that we'll respect the terms of the old CEC contract for a 90-day period. So after your January statement, you will no longer be credited under the old CEC terms. And we hope that by that point in time, all of you will made a decision with respect to which of the 3 options you would elect, and then going forward, your settlements would be based on those options. I see a question that said my estimated savings of 50 years was over $200,000. The question reads, it really seems like the amount being offered is not close. I don't know what savings estimate you were provided by whoever was selling the array to you. What we have seen is that many people who are making sales in this type of environment predicate a savings calculation forward-looking by making assumptions about utility rate increases. And that tends to be a significant component of these imputed future savings. We've used our internal estimates for our rate impacts, which show a rate increase at about the pace of the consumer price index. So a 50-year savings value calculation like that, or Rebecca Driscoll's question, that would be my expectation why there may have been such a generous assessment of what the savings would be.
Jay Harrington also had another question. I believe we also paid into an escrow account purchase for maintenance. So is this in addition to the 10% and Holy Cross Energy retaining both?
So the payments into the escrow account were funded from the 10%. So they're the same.
And to clarify, this is Lisa Reed. Each array has a different escrow amount that ranges from 5 to 10%.
Okay. Rebecca had another question. The program when sold to us was not so much a set payment, but was in kilowatts in and kilowatts out to guard against future kilowatt price increases minus 10% maintenance. So if Holy Cross started charging $10 a kilowatt, it didn't matter because it was based on trade.
I see, Mike. I think what that question is getting at is the calculation of the payment rate under the terms of the contract between Holy Cross and CEC that establish what's called the program. And the program, if you read through your contract materials, terminates when CEC and Holy Cross no longer have a contract. So that contract has been extinguished, and therefore there is no longer a program rate calculation available for the off-takers of the array.
Additionally, on the question, Rebecca, I wanted to note that the way you have that worded is kilowatt in, kilowatt out refers to net metering. And when you have a solar array on your home, you're eligible for a net metering program where each kilowatt hour that you produce is offset by one you don't have to buy from Holy Cross. That is not how the arrays were set up. The arrays were set up on a dollar credit based on your share of the production. It's never been a kilowatt in, kilowatt hour agreement.
I see there's an additional question. Why is the amount offered in scenario 2 so much lower than the amount Holy Cross charges me? So there's a magic word that Mike Steiner used in the presentation where he talked about avoided cost. When the program terminates, the payment rate for energy that was in the power purchase agreement between Holy Cross and Clean Energy Collective expired. So the only mechanism by which a party can sell their energy to a utility in a transaction like this going forward is under the terms of the Public Utilities Regulatory Policy Act, which establishes a resource of a type called a qualified facility. And in a qualified facility transaction, the rate for energy paid by the utility is what's called the avoided cost rate. And the avoided cost is what Holy Cross would have paid for energy, but for the production that was provided by the qualified facility. So in other words, we didn't make a payment to some other wholesale supplier because of the production from these panels. And what would we have paid to the other wholesale supplier? That's the energy price that would be paid to these panels. So when we established the price for option 2, we are using our avoided cost of the energy only piece that we would have paid to Public Service Colorado for energy. The retail rate from Holy Cross includes cost recovery for a lot of other costs in the organization, our buildings, our poles, our wires. And those costs are not part of the avoided cost of energy. I hope that helps answer that question. Go ahead, Mike.
No, I was just going to get Mike Yang had another question regarding the NPV for governmental agencies that aren't tax exempt. can you exclude any allocation for property tax exemption? If not, then why are you allocating property tax expense to all those governmental owners?
I don't know. We'll get back to you with an answer offline for the people on the call who are not or who are eligible to pay property taxes. I'd rather get to some of their questions right now. And Michael, if you'll indulge me, maybe we can come back to you.
Yeah. So we've got another question from Ron. My understanding is that option 2 offers about 25 to 30% of the return I've been getting. Is that correct? And,
yes, Ron, that's correct. However, option number 1 does recognize the current value that you're getting, and that value would be paid in a lump sum dollar amount January, February of next year. So in addition to the exposure associated with, sorry, I got a note while I was talking there. So option 1, you would be recognized at the full value rate projected forward. Mike, I see there's a question from Pat Kiernan about a sample calculation. We do have sample calculations for every participant based on their panel ownership. So rather than share individual calculations to everybody on the phone, and I don't have the spreadsheet calculator open for me right now to do a hypothetical scenario, but we can go up and answer questions on the sample calculations for your specific panel ownership, if you'd like.
Yeah, and Rebecca had another question. Do we pay tax on the sale if we go with option 1? And how does that show in our 2021 return?
That's a great question. I assume that there would be tax implications for that, just like there's tax implications today in the 1099 that you get associated with energy production from the panels. But I don't think Holy Cross can advise you with respect to your specific tax situation. I'm sorry to dodge that question, but I don't think it'd be appropriate for you to answer.
Steve, I'm going to move. We've got some questions in the chat.
Okay.
Where do I find the net? Cash back, how much? Credit percentage, more or less than current? Replacement of panels with current technology.
I'm not sure what the net is. The offer that is provided in the letters or emails that you were sent do provide the calculation for you specifically with our information about your panel ownerships. The replacement panels with current technology under option 3, let's talk about that for a second. In the current termination provisions of your agreements with CEC, the termination option provides that you would either be provided the specific serial numbered panels that you own, or at CEC's option, equivalent capability of replacement panels. Holy Cross expects that for members that pick option 3 and want panels, we would give them equivalent new replacement panels, just because logistically that will be much simpler for us than going and dismantling the current arrays. So I hope that answers that question. We don't have a specific panel selected if you're asking about a vendor name for the panel technology, but we'd provide an equivalent kilowatt capability as a replacement.
Thanks, Steve. We're going through the chat. We've got a question from Holly. couple questions. Can you please explain how the program was terminated? And can you please provide those documents that terminated that program?
So unfortunately, CEC didn't have a standard form of contract with its participants, and there are several different versions of the CEC participation contract with the participants. So I won't cite you a specific section number or anything like that, because I don't know which particular contract version you have. But in your contract with CEC, these refer to the program definition between Holy Cross and CEC. And when the program terminates, that terminates the Holy Cross crediting under the CEC program. So CEC itself is no longer the owner of the sites and the common equipment. So
yeah, and then Steve Holly had a follow-up question. Does that mean Holy Cross was assigned all of these contracts? And if these are terminated by, and she's pointing to paragraph 14 of that contract, it's not clear how you're the party negotiating commercially reasonable efforts to resolve these issues.
I see. Okay, so there's a specific reference to paragraph 14 of one of the versions of member agreements with CEC. Thank you for that, Holly Strabilski. But the situation is the program itself, which establishes the crediting rate between Holy Cross and the CEC participants, is terminated by virtue of the termination of the power purchase agreement between Holy Cross and CEC. And so the question is, which would you as a member or panel owner like to do going forward? If you sell the panels to Holy Cross, we will provide you with a generous offer. And in fact, that's our preferred option. Our offer under option 1 is an attempt to provide you with the value of credits that you would have received if the program had continued through the life of the program, and recognizes the avoided cost payment basis for energy beyond the life of the program for the shorter of either the life of your panels or the remainder of your contract term with CEC. And in addition, we add money in option 1, which allows you to, if you choose to use the money in this way, enroll in the pure program and attain 100% renewable content from Holy Cross, or keep the money and use it for a project of your choosing. The reason this is a preferred scenario for Holy Cross as well is by virtue of the panel ownership, we make our operations and power supply costs more efficient. We no longer have to administer the monthly detailed level bill credits. In fact, the resources that we acquire just pool into the mix of all of our power supply assets. We avoid the IRS tax reporting obligations. Life becomes a lot simpler and more efficient for Holy Cross. In addition, the panels that we purchase, we will subsequently recapitalize and so take as a depreciation expense over the remaining life of the panels. And that has a benefit for the other Holy Cross members that are not program participants, because today the other Holy Cross members are paying for energy from those panels at an effective rate of around $127 per megawatt hour. And by for virtue of the members that sell their panels to us and we recapitalize that purchase expense over the remaining life of the panels, that changes it from an operating expense to a capital depreciation expense. And the overall Holy Cross membership sees a reduction in their power supply costs as a result. So that's the element that makes it a win-win. Our board gave us the direction to try and respect the terms of the panel participants today, but also ensure that this was not a loser for the Holy Cross membership overall. And option 1, we feel, does a good job of accomplishing that. I'll stop.
And Steve, we got a question from John Gitchell, and you kind of addressed our avoided costs and qualified facilities, but in terms of avoided costs, should this price be based on similar production, i.e. a locally produced solar? And what is the cost of locally produced solar that Holy Cross currently pays?
I'm trying to find that question.
Yeah, it's in the chat, Steve.
It's who's the name of the person who asked the question?
It's John Gitchell.
I don't know why I'm not seeing John's question in the box here. Is it possible that it was under Q&A?
That particular question was sent directly to the host and presenter.
Okay, I'm so sorry. I don't see the question. Mike, could you please repeat the question?
Sure. So John's question is really option 2. You touched on why this price per kilowatt hour is 72%, about 72% less than the current deal. Could or should this price be based on of similar production, i.e. a local produced solar project? And what is that cost of locally produced solar that HCE currently pays?
I see. So the short answer to that question, John, and thanks for the question, short answer is no. Under a qualifying facility transaction under PURPA, the payment price for energy is not referenced to a similar resource. It's referenced to the cost the utility would have paid for energy at the margin. And so we're using for our avoided cost number the wholesale power supply contract that Holy Cross has with Xcel Energy / Public Service Company of Colorado. Because at the margin, the energy that we would have to buy to supply our loads would be under that contract. I hope that answers your question.
Steve, we got another question from John Ward. Good question. Help me understand how to place a value on the PURE program. As I understand it, CEC will simply pay premium.
Okay, so a couple elements
here. The premium one would occur to receive 100% renewable, but not the cost of the energy itself. So if the cash payout is insufficient to cover my original investment, it doesn't shore that up. Again, it only pays the fee to participate in that program, correct?
Yeah, somewhat correct. Let me talk about that for a little bit. The question referred to CEC making that payment. So no, CEC is no longer a party to any of these transactions. But in the option 1 offer, what Holy Cross is recommending when you take that option is not only the payments for the projected value of energy production from the panels, first under the current program prices and then under our avoided cost in the further out years. But we're offering an additional lump sum of cash that reflects our projected cost for your account to participate in PURE based on the energy consumption profile that you had in the year 2019. So we don't know what your energy consumption might be in 2025. And if your energy consumption doubles compared to 2019, that would potentially increase your cost for participating in the PURE program. But that's not the only factor involved. Our projected cost for your participation in the PURE program is based on our projections for the amount of renewable energy supply that will be part of the Holy Cross portfolio. We expect that by the year 2030, we will be at 100% renewable energy supply. So in the years beyond 2030, there basically would be no pure program anymore because anything you buy from Holy Cross would be 100% renewable. In the years between now and 2030, we used a profile for our annual renewable energy content. And the amount or the cost of participation in Pure is a kilowatt hour charge times the percent of your system supply that's not already renewable. So from that, you can see that as Holy Cross becomes more renewable, the cost of participating in the Pure program goes down because there's less supply content to have to make up on a renewable basis. But our projection used our current resource plans. They were conservative in favor of the members' valuation of Pure in that we did not front load the renewable content in our power supply projections. We put the increased renewable content more in the out years, closer to 2030. So we feel that's a conservative calculation. If you take option one, you can tell us you'd like to be enrolled in Pure, and the cash that we give you with your check in January or February of next year associated with option one would be of value to cover your costs of participation through the year 2030. That answers the question.
Yeah, on those lines, Jason White had a question. Will the HCE Pure program also include the energy credits from the CEC arrays in this discussion, or primarily a large wind farm on the eastern slope?
Good question. It will include all of the renewable energy content. So the Pure program covers members getting renewable content for the portion of Holy Cross supply that's not renewable. After this purchase of panels is completed from the members that choose to sell to Holy Cross, the renewable production from the CEC panels will become part of the default renewable supply for all Holy Cross members. And so that will increase the default renewable content in the Holy Cross system and will reduce the cost of Pure participation. And then on the second part of that question, the ownership of RECs handled with the Pure program. For members that enroll in Pure, we track our obligation to retire renewable energy credits. And then through a specific account associated with the program, we retire additional RECs to offset and provide for that renewable content associated with their participation.
Thanks, Steve. Got a question from Bob Wilner. If I have a credit balance still after the January statement, how will I receive any outstanding credit due to me after that statement?
This is Lisa. I can take that one. For those members whose production credits have exceeded their energy usage and they're carrying a credit on their current electric bills, that is your credit, and you can receive that once the options are complete. So if there is a credit on your electrical account with the exercise of your option, a separate transaction, you can request to have that credit refunded to you instead of carrying it forward.
Thanks, Lisa. We have a question from Dave Everett. The question about our seemingly mandatory entry into the core program, assume that's the REMP funds, to quote your information via email, whether or not we elect to participate seems pretty arbitrary. Is that amount something you are contributing, or is it something you offer me to purchase my panels?
Mike, the question asked about core, and then you mentioned rep. So just to be clear here, I assume the question referred to the option 1 discussion around our pure program.
Yeah, I think, go ahead.
And so let me respond to that. We're not making enrollment in pure mandatory under option 1. The offer in option 1 includes a cash payment to the member to sell their panels. Cash payment both the projected value of energy production and what we estimate it would cost you if you choose to participate in the pure program. There is not a mandatory enrollment in pure. If you accept option 1, you can take the dollars associated with the value of participating in pure, put it in your bank account and use it to pay for your pure participation in the future if you choose, or you can use that money for any other purpose you choose. Mandatory enrollment in pure is not.
Right. Yeah, Steve, I think he's alluding to the core REMP that they use for theirs, and in this we didn't calculate any sort of mandatory participation in any sort of core REMP programs. Okay.
There's a question I see here, Mike, from Greg Hales. When does the Holy Cross Board meet in January, and when would we receive a check? Usually the Holy Cross Board meets the third Wednesday of each month, although a board meeting is not necessary for purposes of you obtaining your check. We expect the check payments would take place in January and February of 2021. Administratively, the sooner we can get members to provide us with their selected option, the sooner we can move forward with the program rollout.
Okay, I have a question from Christine Johnson. I think this pertains to the second option. What happens to the credit amount that remains on my HCE account? Can I keep that?
Mike, I'll take that. This is Lisa. And I think that you're referring to not the foregoing credits that you would get if you chose option 2, but a current credit on your electrical account. That is your money, and you do keep that. And after the program options are chosen, you can choose either to have that refunded to you in a check form, or you can continue to carry that forward to pay for future electrical bills.
Okay, thanks, Lisa. Rebecca Driscoll had another question. Why did CEC go under? Was the model prove not sustainable?
This is Steve Boyning. I honestly can't respond to that. I think CEC obviously must have had their reasons, and I don't know what they were. I suspect that there probably were tax considerations involved, but that's just speculation on my part. So probably be better to try and direct that question to a representative of CEC.
Okay, we've got another question from Gordon. How do I find out the total of the month-by-month credits from Holy Cross since buying CEC panels? And follow-up question, how does the difference of the original panel cost and Holy Cross buyout differ from the total monthly credits from Holy Cross? Is it more, less, or equal?
On the first question there, Lisa, can you help me? Is it feasible that we have a record by account of the history of the credits that have been paid over time?
Yes, we can pull that information. It was entered on each one of your monthly bills, and we can download that data for you, Gordon. If you'll reach out to me at Holy Cross, Lisa Reed, we can get that information to you.
Lisa, on the second part of Gordon's question regarding the original panel cost, I'm not sure if we're privy to your original panel cost. So it's my understanding anyway that that was not a uniform cost for all members. So I'd have to answer that with, that would be difficult for us to provide.
Correct, Steve. Along with that, we do have some, but we don't have the majority of them. And in particular cases, we can look at, or you can share that information and then compare it against your option 1 buyout amounts.
Mike, I see there's a question or a comment in the chat box. Pure sounds like semantics. Watt is running through the system. There's no differentiating where it was generated from, and no separating 1 kilowatt from another. That's true from a physics perspective, but I like to use a banking analogy. When we put $1 into our savings account, we recognize that we may not get that individual dollar bill back, but that we have a valid credit in our account associated with the money. And renewable energy credits are a valid mechanism for accounting for the claim to renewable production associated with a green facility. So while it's true that from a physics perspective, once electrons dump onto the grid, you don't get that individual electron back. There is an accounting technique that's valid for purposes of tracking renewable content. That technique that's used by utilities for this purpose is the REC system. If you'd like more information through the internet about the REC tracking system that's used by Holy Cross and most other utilities in the Western United States, you could Google this acronym, WREGIS. It stands for Western Renewable Generation Information System. And this is the accounting repository that Holy Cross uses to validate and track its renewable energy accounting entitlements. So I hope that answers that question.
Another question. Can you give us an example of how option 1, 2, or 3 would affect our future electric bills? Assume I own enough panels to be energy neutral today.
And Steve, I can take that. This is Lisa. Option 1 and 3 would terminate your participation in getting a bill credit. Your electric bill would be equal to what it would be today if you remove the credit that you are receiving on the bill. Option 2, you would continue to receive a monthly bill credit. However, it would be at the reduced amount.
Thanks, Lisa. I think we have kind of a tax question from Phil Golden. Would the sale price under option 1 be considered a return of capital or an ordinary income?
Ooh, that sounds like a tax advice question that I don't think Holy Cross should answer. I think that depends on your tax filing details. So decline to answer that one with apologies.
And another question from Rebecca, and I can kind of answer this, is feeling warm and fuzzy, the only benefit from Pure. Keep in mind, enrollment in Pure contributes to our We Care Fund. And that helps support all of our membership with energy efficiency rebates and helps us support more local renewable investment. As Steve alluded to, our goals of getting to 100% renewable energy hopefully by the 2020 or the 2030 timeframe. So really we do use those funds to help support a lot of our clean energy initiatives. So those funds are being used. And Steve, if you want to add on anything to that.
Sure. I'd just add on that in 2019, we used revenues, including the revenues from Pure, to install over 300 kilowatts of additional PV for the benefit of the Holy Cross system. So it is the funds that are paid in Pure are being used to reinvest in renewable resources in our footprint.
And one thing that I might point out here in regards to the program, under your customer agreements with Clean Energy Collective, the renewable energy credits, basically the right to claim the renewable energy, has always been owned by Holy Cross Energy. So under the Clean Energy Collective program, you did not have the claim to that renewable energy. Holy Cross did, and Holy Cross still will continue to have the claim to the renewable energy from the Clean Energy Collective arrays for the benefit of the membership.
I can help on this question. Bill Gibson asked, if we join the Pure program, how long do we have to stay in the program? In other words, if we join your program and the rates triple, can we get out? The Pure enrollment is simply a call and email contacting us, and we put you in the system and we enroll you in Pure. And so there's no contract or any obligation for you to maintain in the program. We'd ask, and it's at your discretion, that you'd enroll for a year. And if you decide to unenroll within 3 months, that's okay too. And to your question, if the rates triple, can we get out? The Pure program is based on our renewable energy content. So this year, and correct me if I'm wrong, Steve, we were at our renewable energy content of our Holy Cross Energy power supply was 44%. So the Pure program is based on the delta between getting you from 44% to in that 56% to maintain 100%. So as we alluded to, as we get more and more renewable power supply content on our system, those Pure costs will drop. So really, I don't see a scenario where those Pure rates will double, triple, or even go up any in value. If anything, they're going to go down in costs. So hopefully that answers your question. And Steve, Lisa, feel free to jump in.
And to be very clear on that, in option 1, we are offering you the bonus payment that would allow you, if you choose to enroll in Pure, presumably pay for it through 2030. You are not obligated in any way to enroll in Pure. We just give you that bonus and encourage you to do that, to become 100% renewable and support future renewable energy in the territory.
Mike, this is Steve. I see a question from Dave Everett asking about his specific calculation and the components in the buyout offer. Dave, I wonder if we can follow up with you and walk you through the component calculation with the numbers that are specific for you.
Yeah, and it's just past the hour. Yes, we can leave it open for any other questions. But for any folks, if you want to follow up, we have a phone number that is forwarded to any of us who can help you with these questions. If you have additional questions, we're happy to answer them. And really appreciate everybody taking some time. I know this is kind of a complicated issue, and we're really trying to keep our members whole as CEC exited the business. But we'd like to discuss with any other questions that you have, no matter what they are. Please feel free to contact us. And kind of give it a minute or two if anybody has any more questions for the chat. Okay.
Mike, this is Steve. I just wanted to thank everybody for participating today. We appreciate the chance to work with you as we transition this supply into the Holy Cross portfolio, and look forward to working with you as you select from your 3 options. So thanks.
Yeah, thanks again, everybody. We really appreciate the time this morning, and look forward to your follow-up. Feel free to contact Holy Cross. You can contact myself, and we can get you answers to any questions. Again, thank you guys so much, and feel free to reach out. Thanks, everybody.